Welcome, everyone, and thanks for joining us for today's webinar, Capital Gains. The webinar will last 15 to 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thanks, Jennifer, and hello, everyone. Thank you for joining us today. We're going to talk today about capital gains tax. We'll spend some time talking about how capital gains are calculated and the role of the capital gains rate from the federal income tax perspective, as well as the role of basis in that calculation. We'll also talk specifically about when that tax applies. But before we get into the nitty-gritty of capital gains taxation, let's go ahead and decide on what we're going to cover during next month's webinar. Here are the choices. For next month's webinar, the choices are ethical issues with incapacitated clients. The second choice is dealing with terminal illness. And the third choice is developments in deferred compensation and developments as they apply to life insurance professionals. Let's go ahead and open the poll, and let's let you vote on what we will talk about next month. Go ahead and cast your vote, and I'll give you about 30 seconds and we will sort it out. Go ahead and vote now. Thank you for doing that. It looks like everyone voted. Thank you for that. We will talk about next month about deferred compensation. So thank you for that. And let's go on and talk about capital gains tax today. So when we deal with capital gains tax, we're focusing mainly from a federal income tax perspective. We realize there are potential state income tax rules, but each state is a little bit different. So we'll come at it from the federal perspective. When an asset is disposed of, usually sold, right? Gain or loss is usually recognized on the transaction. And most assets that are sold or otherwise disposed of are considered to be capital assets, and the person who is disposing of them, selling them, will either pay capital gains tax on the gain or will recognize a capital loss that is potentially income tax deductible. Why is capital gains tax important to know about? Well, capital gains tax rates are generally lower than ordinary income tax rates, and so selling a capital asset costs a client less than selling a similar asset that might be subject to ordinary income. So that's why we need to know about that. Most assets are capital assets. The IRS has carved out certain kinds of assets that are not capital assets. I think it's important for us to know that inventory in business, accounts or notes receivable, a lot of intellectual property, supplies that are consumed in a business, those are not considered to be capital assets. If they're disposed of at a profit, then we have to deal with ordinary income tax consequences rather than capital gains taxes. And Jennifer and I, when we talk to our clients about life insurance and annuities, we're surprised, I think, that sometimes Even life insurance professionals think that on the disposition of an annuity contract or on the surrender of a life insurance contract that capital gains result is generated. That's not true. If there's gain recognized on the surrender of a life insurance contract or an annuity contract, it is ordinary income. That's defined in the tax code as ordinary income rather than capital gains. And the distinction is important because, as I mentioned earlier, the rates are different. Rates are generally lower for capital gains as opposed to ordinary taxable income. In order to properly calculate capital gains tax, it's important for someone to understand what their basis is in a particular asset. Usually basis is what somebody has paid for the asset, but that's the original basis, that's the acquisition cost, and that's not always the current basis because basis can be adjusted upward or downward depending on the circumstances. For example, if a capital asset is used in business, a lot of times that asset will be depreciated. And so if depreciation is taken on a particular asset, the basis will be correspondingly lowered. That's just one example. Even though life insurance and annuities are not subject to capital gains tax, those of us who work in those areas understand that the basis for a life insurance contract or an annuity contract might be affected by distributions from the contract. So there are, and then one more example is if we have a client who owns an S corporation, the client's basis in an S corporation may be increased or decreased depending on the results, the business results inside the S corporation. Because an S corporation is a flow-through entity, results in the business will affect basis. So all of those things may affect basis, and having the right number for basis is the key to calculating capital gains or losses correctly. So when we've got capital assets that are transferred in ways that don't involve somebody purchasing them, where there's a purchase, the acquisition cost ends up being the new basis in the hands of the transferee. When assets are transferred by gift, for example, basis is calculated differently. So if I've got a capital asset in which I have a $10,000 basis, and I make a gift of that asset to my son, in general, my son's basis in the asset is also going to be $10,000. That basis is carried over when I make a gift transaction to somebody else. That's true also if I make a gift of the asset to my spouse. But what if I sell the asset to my spouse for its fair market value? Well, the tax law says that if there's a sale of an asset to a spouse, that's carryover basis. The spouse doesn't get credit for the full acquisition cost. The spouse gets the same basis, even if I sell the asset to her, the same basis that I had in the asset. What about transfers at death? Well, we still got a good rule in the Internal Revenue Code that says that in general, capital assets get a step up in basis or a step down in basis to fair market value as of the date of death. And so there's an example here that shows that if Judy owned $10,000 of publicly traded stock, bought it for $1 a share, basis was $10,000 because there was no adjustment since 1950. Judy's subsequent death, when each share is worth $100 at an aggregate value of $1 million, means that the heirs get a step up in basis to the full $1 million. Even though if Judy had sold that stock a week before her death for that same $1 million, she would have paid $990,000 in capital gains. Her heirs get a step up in basis, and so if Connie, Judy's daughter, receives that share, those shares at Judy's death and then subsequently sells them the day after Judy's death, she won't pay any capital gains tax because her basis will have increased. So these are the capital gains brackets for 2019. There's a lot of confusion associated with these brackets. You know, people think of it as people being below a certain threshold will pay a capital gains tax of a certain rate. For example, here we've got joint filers where it says that if their income is below 78,750, they're in a 0% capital gains rate. And so a lot of times Jennifer and I will get calls that go something like this. Well, I've got somebody who's married filing jointly. They've got $75,000 of regular income, and they want to sell a capital asset that has a large gain. Will they pay 0% tax on the whole gain? And the answer is no, that's not how it works. We'll go through an example of that in a second. But first of all, let's think about the interplay between somebody who's got multiple capital gains and losses. So gain is recognized if an asset is sold at a gain. Losses are recognized if an asset's sold for less than its basis. Figured taxable gains. Taxpayer must first calculate net capital gain. That aggregates all long-term gains and losses. Long-term gains and losses are on assets that were held for more than a year. Once the taxpayer aggregates all long-term capital gains and long-term losses, then the taxpayer subtracts out short-term capital losses and any other losses, capital losses that were carried over from a prior year. If at the end of the day the taxpayer's got a net capital loss up to $3,000, up to $3,000 can be deducted from ordinary income. That's the limit. $3,000 of net loss can be deducted from income. So what's the interplay of all this? Let's go through kind of a numeric example and talk about George Jetson and Jane, his wife, who had the following transactions in 2019. They've got a long-term capital loss of 50 grand, a short-term capital loss of 10 grand, long-term gains of $75,000, no short-term capital gains, and they've got a $10,000 or $20,000 net capital loss carryover from 2018. So in order, the Jetsons first subtract their long-term capital losses from their long-term gains. So 75,000 of long-term gains, 50,000 of long-term losses. That leaves $25,000 in net long-term gains. Then the Jetsons add together the $20,000 of carryover and the short-term losses of $10,000. That makes this year's total loss $30,000. You net that out against the $25,000 gain, and it yields a $5,000 net loss. Well, the most they can deduct this year is $3,000 of that $5,000 loss, and then they'll carry over the other $2,000 loss to 2020. So that's how, that part of the equation works. There are some capital assets that have special capital gains rates. I just mentioned this in passing so that you're alerted to it. Certain kinds of accelerated depreciated properties, collectibles, qualified small business stock, all of that has the potential to be taxed at different capital gains rates. So you should be aware of that. So let's go through the example. I said earlier that a lot of people are confused. They think if somebody's has ordinary income below the threshold for the 0% capital gains rate, that they can sell a really appreciated capital asset at 0% capital gains rate. And that's just not true. They get some benefit from the 0% rate, but they have to stack their gain on top of their other income to figure out what other bracket they might be in. So here's an example. So we've got Ricky and Lucy, married couple, $50,000 in regular income in 2019. Ricky sells his business for 250 grand in 2019, all of which is gain. So the Ricardos here are below the threshold for the 0% capital gains bracket, but they've got significant capital gains which will push them over the threshold. The threshold is 78,750. So when you subtract the $50,000 of other income from the 78,750, that means the first 28,750 of capital gains is going to be taxed at 0%. And then the next portion is taxed at 15%. And so the total capital gains tax on the sale of Ricky's business is $25,838, which is an actual rate of just over 10%. So you've got to stack the actual capital gains on top of ordinary income to figure out which brackets you might be in for capital gains purposes. Quick second example, same numbers except that the business is sold for $1 million. So the first 28,750 of gain is again taxed at 0. The next 410,100 is taxed at 15%, and the final $500,000 plus is taxed at 20%. In addition to the 20% capital gains rate, the couple is going to be subject to 3.8% Medicare surtax. The surtax threshold is 250 grand, and so they will be over that, and they will pay some 3.8% Medicare surtax. And so putting it all together, you can see from this chart that their total taxable event on the sale of Ricky's business is just over 200 grand, or an effective rate of about 20%, a little over 20% on the sale of Ricky's business. So bottom line here is don't be misled by somebody being below the threshold thinking that you can sell capital assets with impunity and pay no capital gains rates. It doesn't work like that, and I hope these examples illustrate that for you. So there are headaches that our clients will try to have us share in. The biggest one may have to do with basis. Taxpayers don't always keep perfect records about basis. My strong recommendation is if your client tries to get you involved in a conversation about basis, refer them to their CPA. CPAs are used to dealing with imperfect information and shoring up the record against the possibility of an audit. I'm not saying that CPAs help their clients mislead the IRS. That's not what I'm trying to say at all. What I'm trying to say is that there is evidence that can be reconstructed about basis that may be more indirect, that the CPA will be good at helping to sort out, which those of us who don't prepare tax returns for a living, we just wouldn't be able to do. So if the client doesn't have any information about basis, the client is supposed to use a $0 basis, so there's a real incentive to try to reconstruct basis records as well as possible for a client. What do we do with clients who are trying to avoid capital gains taxes? One idea is 1031 exchange. Generally, 1031 exchanges are used in conjunction with income producing or commercial real estate. It is a very specific process that a client has to follow. It requires the use of a qualified intermediary. In a lot of cases, that's a closing company or a title company that does 1031 exchanges for a living. and the process must be followed well before the sale of the property for which the client is trying to do a 1031 exchange. So if the client comes to you after already selling the property, there isn't really any opportunity to use a 1031 exchange. Another way that a client might try to manage capital gains tax is to use some kind of installment sale process. Instead of getting a lump sum on the sale of a capital asset, the client would settle for a series of payments from the buyer, and if it's done properly, the capital gains result can be spread out over time. Another idea that we sometimes talk to our callers about for avoiding capital gains tax is through the use of a charitable remainder trust. The bottom line there is that if a client doesn't really have charitable intent, it's not a great idea for avoiding capital gains tax. If a client does have charitable intent and wants to reward a charity ultimately with part of the proceeds from the sale of a property, it's an idea that is worth considering. They're fairly complicated and expensive to set up, not overly so, but this isn't for the average client. In any event, it is an idea that should be thought about if somebody has a potential sale of a big enough capital asset that that the capital gains taxes are potentially hundreds of thousands of dollars. So what are the conclusions that we should take away from this? First of all, capital gains taxes can play an important role in our clients' financial lives, particularly our affluent clients. Concept does seem simple. The actual calculations aren't always easy. Our clients want us to help them. We can provide some help in helping them think through the approximate capital gains tax associated with disposing of some valuable assets. And even where we can't help our clients reduce capital gains taxes, helping the clients think through the consequences of selling a capital asset, that's certainly a level of service that we should be providing. I want to thank you for joining us for today's call, and at this point, I will turn the program back over to Jennifer Lawler, who will wrap it up. Jennifer.
Thanks, Linus, and thanks for joining us today. And don't forget to join us next month for developments in deferred compensation. As a reminder, if you would like to receive supporting materials about today's presentation, please feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.